Just 16 minutes before a major government announcement regarding de-escalation in the Middle East, a mystery speculator flooded the futures market. Depending on the exact execution, that single string of trades generated as much as $60 million in profit. Life-changing wealth generated by a perfectly timed oil prediction contrasts sharply with the physical toll at the pump. Everyday citizens currently absorb massive economic volatility, with some paying well over $7 just to get to work. Whoever made these trades bypassed any attempt to hide their activity. They moved hundreds of millions of dollars in notional value in the span of exactly 60 seconds to catch the window before the news broke. This volume spike illustrates a system where those with advanced knowledge extract wealth directly from the market, leaving the public to manage the resulting economic fallout. The historical political strategy of the news dump has evolved into a mechanism for market manipulation. As financial markets provide a live updated indication of national competence, scheduling government announcements has become a profitable tool. Damaging news is systematically released late on a Friday evening, landing after the trading week has closed to bury immediate panic. Conversely, positive, market-saving news is held back for Monday morning. Releasing it right before the opening bell triggers a predictable, immediate rebound. Every single major market-moving announcement following this specific scheduling pattern over the past year has been accompanied by highly suspicious trading activity. Geopolitical policy announcements are no longer just matters of state. They serve as meticulously timed windows for guaranteed financial gain. The Stock Act of 2012 requires members of Congress and their senior staff to publicly disclose their financial trades. Legal transparency is often undermined by the delivery method. The government hosts this data on archaic 1990s-style digital portals that make it nearly impossible for the average citizen to track these disclosures organically. This obscurity led to the rise of third-party tracking websites. These platforms digest complex filings, allowing retail investors to copy the portfolios of their elected officials. While these tools provide clarity, they have normalized the behavior. Public reaction has shifted from outrage to participation, as borderline treasonous activity is rebranded as a retail investment strategy. Disclosure data reveals that the vast majority of lawmakers actually underperform the broader market, maintaining simple buy-and-hold portfolios. However, an elite group of senior lawmakers consistently pulls up the congressional average, with a specific minority outperforming their peers by a staggering 47 percentage points. This gap is driven by a committee premium. Sitting on powerful legislative committees grants advanced knowledge of industry-altering policies before that information reaches the public. Lawmakers serving on the Agricultural Committee, for instance, have been found trading commodity futures while actively drafting the very farming legislation that moves those prices. Senior leadership frequently trades in major semiconductor stocks while simultaneously shaping and passing the multi-billion-dollar CHIPS Act. This outperformance relies on committee proximity rather than financial genius, as specific legislative assignments are weaponized to ensure personal wealth. Beyond the individual millions made by politicians, these financial incentives inflict systemic damage on the country's legislative integrity. A lawmaker is unlikely to pass a policy that benefits the American public if that policy damages their own heavily weighted investment portfolio. This inherent conflict of interest delays vital trade deals, distorts legislation, and undermines global trust in America's stability. Personal financial incentives drive national policy decisions, altering the trajectory of the country to protect the portfolios of a powerful minority. The U.S. Economic Uncertainty Index currently sits at its highest point outside of a global pandemic, driven by self-serving and unpredictable policy choices. Global lenders track this instability, leading to the introduction of a debt risk premium on American borrowing. This chart illustrates the correlation. As uncertainty regarding the integrity of government decisions rises, the premium demanded by lenders to offset the risk of lending to America climbs alongside it. This resulting risk penalty has contributed to a massive surge in national debt interest repayments, which have more than doubled in just the last 5 years. While insider trading is only one part of the problem, it provides a direct financial incentive for lawmakers to maintain the very systems that create this instability. Ultimately, the American taxpayer is footing the bill through higher inflation and a ballooning national debt.